Mark Delaney, you've said that Australia is heading for a material downturn. What does that look like for this average Australian household?
Well, it's a long time since Australia's had a decent economic downturn, and the likelihood of much higher interest rates makes this a much higher probability than what we've seen for a long time. The last downturn we saw really of any magnitude was the financial crisis, 2007 to 2009. And with high inflation coming all over the world and increasing in Australia, we think we're going to have another period where we're going to have a period of sustained economic weakness. I think that's going to result in higher unemployment, eventually lower prices, and less overall froth in the economy.
So unemployment's sub 4% now. How high do you think it's going to go?
You can always look back through history and say, well, how high does unemployment rise in downturns? And that's what I'll do, and that's what everybody else does, without really knowing. Probably you'd say that it'll rise at least 2 or 3 percentage points higher than where it is now, is most likely. But it has been higher than that in very deep economic downturns, but we just don't know how this one's going to pan out.
You've got $300 billion of Australian savings under management, so let's do some quick fires on where you see the economy and markets heading. Where will the ASX be by year end?
Oh, very hard question to make short-term market forecasts. It's something I don't generally do. So I think the markets are having a very difficult period. I think that's likely to continue, but we've just had a very sharp sell-off in the last week or two. So I think markets we expect will generally be weaker from here, but putting a level on it is almost impossible.
What about US markets? Are they going to continue to fall?
Yeah, the US markets are the most interesting because this is the epicentre of this whole market sell-off. The Nasdaq was 10,000 prior to COVID starting, and that was when people thought the Nasdaq was already getting toward bubble territory. People talk about the FANG bubble and those things. Between the start of COVID and December last year, it went from 10,000 to 16,000, up 60% in 18 months. What we've seen in the last 6 months is it go from 16,000 to almost back to 10,000. So what you're seeing really is a popping of a money-fueled technology bubble. And it's probably, people don't see that often in their lifetime, a bubble unfolding in investment markets, but this was one of them. And you look back and say, clearly it was one, and it's now being pricked. It's come all the way down. So it's much better value than what it was 6 months ago, but still US markets are expensive on long-term historical averages, and so you would be concerned whether or not they're going to hold up from here, particularly if the US experiences a recession.
What about the cash rate?
Well, the market is pricing in cash rates going to almost 4%, which would imply mortgage rates going close to 6%. I'm sceptical that household balance sheets can stand that degree of interest rate rises. So I think it'll end up being lower than that. But it really depends upon how hard it is to unravel this inflation problem we've got. So if it keeps on going, interest rates will have to keep on going up. The key point here is the way the interest rate market is priced, it's pricing inflation coming down materially. So if inflation disappoints and stays up, interest rates will be under further upward pressure.
And where do you see inflation peaking? The RBA has said this week that they think it's going to be around 7% by Christmas.
No, because you wouldn't think if inflation stayed at 7, interest rates would only be at 4. That doesn't make any sense. So clearly, it's where they think inflation is going to come down to and how quickly it comes down, which is what matters.
What about the more exotic investments that have found favour over the last few years while money's been cheap, like crypto, the zero profit, high share price tech stocks that we just spoke about?
Yeah, I think that free money inflates a lot of things. And we saw a lot of those investments at the fringes of the investment spectrum rise dramatically in value. As money becomes harder to get, quantitative easing becomes quantitative tightening. It's going to be much tougher for those investments. So I think a lot of those things will deflate, and they're all just aspects of what I call this money-fueled technology bubble.
How real is the risk of recession?
Oh, I think it's quite material.
Australia or world?
Oh, I think globally, and Australia finds it very hard to be exempt from it. Australia did avoid some of the recessions of the world from the 1990s through the 2000s with the booming China, but those preconditions those conditions aren't likely to be repeated.
Is that the key risk, do you think?
I think there was two risks. The first one was the popping of the technology bubble, which is really well advanced. And the second one is a global recession, which is now the biggest risk, I think.
How worried are you about the level of Australian government debt?
There's no magic number for government debt. Economists and people have argued about this for some time. But it is clear that governments massively increased their balance sheets during COVID and spent a lot to keep economies working. They won't be in a very strong position to handle the next downturn, given where they're starting from.
What do you think that means?
I think they're going to be less able to put large stimulatory fiscal policies in place, which will make it harder to bounce back from any downturn.
You're on track to post your first financial year loss in 13 years, with your main super product down 0.8% to June. What's your message to members?
There's going to be years when you make negative returns. It just is a part of how you build wealth. There's been a recession almost every decade in the US since the 1800s, and a bear market every decade since the 1800s. So we think you're likely to make negative returns maybe 3 years out of 10. Our experience has been much less than that, but still negative returns are part and parcel of building long-term savings, because that's really the risk you take to make all the big gains we've seen for the last 13 years.
Mark Delaney, thank you so much for your time.
Thank you.